the reason that I like NRP so much is just that it's capital light. I mean, they don't own pretty much any of the mines here that they partner with. So all the CapEx goes to the miner themselves, and they just basically manage their property. They have, 55 employees. They don't need to add more employees, so that, they don't have a lot of costs. That's why they have these insanely high free cash flow margins.
On today's video, my co-host Kyle Grieve will be sharing a stock presentation on a company called Natural Resource Partners. This presentation was given in our TIP Mastermind community, which is the highly vetted community run by TIP for private investors, portfolio managers, and high net worth individuals. We host weekly calls with the community similar to the one we're sharing with you here today. Around the first half of the video is a presentation from Kyle giving an overview of the business and why he initiated a position for his own portfolio. And during the rest of the video, we had some great insights and questions from a few of our members of the community as well. With that, let's dive right into today's video covering Natural Resource Partners.
Welcome everyone to my presentation here on Natural Resource Partners. Really looking forward to bringing this name to you. And as we were talking about just before this call started, it's a lot different of a name than many of you might expect that I would be interested in. So let's get into the business. So Natural Resource Partners, the way I see it, has two primary segments. You can make the argument that it has three, and I'll be going over what that is, but the third one right now is kind of immaterial. So first segment is mineral rights. So NRP, essentially, they just own a lot of property. And so one of their segments for making money is just basically owning the rights to that property and then allowing other businesses to go on their property, use them, extract a variety of different things. Most of it is going to be coal, that thermal and metallurgical coal. And then NRP just takes a royalty. They have some other segments in oil, gas, industrial, minerals, and aggregates, but it's a very small percentage of revenue. So I really don't pay too much attention to that. I'm definitely most interested in the met coal part of the business. I think in their 2020 annual, they actually disclosed some of the reserves they had, and it was a lot of reserves that are going to last for a really long time. So that's why I have 50 plus years here of reserves. So the second segment of the business is in soda ash. So they own 49% of CCCAM mine, which I'm butchering the name. I'm not even going to bother saying it the way it's supposed to be pronounced, but it's basically a Turkish business that owns the other part of the mine and they operate it. They basically do everything. NRP just basically gets to collect a nice check from them every quarter. Soda ash is used in things like manufacturing glass, textile soaps, EV batteries. CCCAM, the kind of parent company, is really into glass. So I think that's where their interest for this business came from. So the third segment here that I'm not putting as much emphasis on, although it could be something interesting, is their carbon neutral initiatives. Got a lot of future potential in carbon sequestration, but currently they haven't really flexed that part of the business yet, just because I think interest isn't super high at this moment. But when interest rates changes and the closer we get to this zero carbon goal, I think this could be a very interesting tailwind for the business. So let's go into some of these segments in a little more detail, starting with the mineral rights segment. So in total, they got about 13 million acres of land. So it's quite a bit of land. And, a lot of the land is not doing anything, but they have enough land where there's some places that are very interesting. So as I mentioned earlier, they earn a royalty based on the volume and price. When we're looking at coal, it's just the volume of the coal and the price. And obviously those two variables can change quite a lot given, the year, quarter, or what's going on with prices. So the reason this segment is obviously the most important is it makes approximately 80% of the revenue. At least it did in 2023. 2023 is an interesting year. It's kind of an outlier year. Their free cash flows were quite high. It's not something I would expect going forward, but because of the pricing of coal and even soda ash as well, it kind of makes the numbers a little bit wonky, but it was a good year for them. One of the issues I've gotten when I talk about this business is, okay, well, what happens if a mine just, I don't know, for whatever reason, just stops mining coal, or they don't mine enough coal to make too big of a difference to NRP. So the way NRP has it is that they take a higher number, whether that's the percentage of a fixed number on the sale price or per ton of minerals sold. Luckily, they've done pretty well at partnering up with businesses that do stay in business. They've had some that have gone out of business, and they've even had some that entered bankruptcy, and then they had to restructure the deal, and then they came back out of bankruptcy and they kept going on, which was great. So the way that this works, from my knowledge, is if a mine, for whatever reason, doesn't mine enough, they'll basically take this kind of percentage as a minimum, and they'll add it to future payments so that once the business gets back on its feet, they get paid that way. So some of the leases they have are very long-term. 2/3 of them are in this kind of 5 to 40-year range. So they have some really, really good long-term leases with really good companies like, AMR, for instance, is one of their biggest customer. When we look at kind of the segmentation of their actual whole royalty between thermal and metallurgical, it's about 75% of their revenues coming from met coal, and that's on about 60% of volume. And that's just because met coal is more expensive than thermal coal. So the next segment here is the soda ash segment. Like I said, they have a minority interest here in soda ash. It's the mines in Wyoming. In 2023, this segment was about 20% of revenue. So CCCAM Resources is their major partner. Like I said, they're this giant Turkish conglomerate that specializes in glass manufacturing. It has some tailwinds. If you look out the next 5 years, it looks like that soda ash is going to continue growing here. So that'll be nice. I will mention here, pricing for this segment of their business has come down quite significantly. Inflation definitely boosted the prices. So just a little bit of background on soda ash. It's produced just in a few key places. US, Wyoming is the only place in the US, Turkey, China, India, and Kenya. So, it's not something that's widely available. And then talking about the NRP's kind of deal here with CCCAM Resources is that they're pretty much hands off. They just allow CCCAM to do everything, which obviously makes it so that they don't have to spend pretty much any money on the partnership. So here's some of the numbers here. So in the latest quarter, they made about $8 million in net income. But if you go back, look at 2023, 2022, you can see how these numbers kind of spiked. And I think that was due to just inflation. And now that it's starting to come down, we're seeing more of a normalization in prices. I think you can probably expect somewhere around $30 to $40 million is probably a decent number to rely on in the future. But again, like the rest of the business, it can go up and down. The third segment here is their carbon neutral initiative. So out of their 13 million acres, they add about 3.5 million that can be used for subsurface rights for the sequestration of greenhouse gases. This is kind of like a call option. It has no downside. The beautiful part about this business is that, even on these direct air capture plants that like Oxy's building on their land in Texas, they're not having to spend any money. So essentially, once those operations go online and they start storing some of these byproducts in the reservoirs, they'll start collecting a royalty check, kind of similar to they do with coal. So yeah, there's not really any downside. It could not work at all. Maybe, I don't know, maybe some other technology comes along that's better. But there's not much downside and there's a decent amount of upside. So they have had a couple one-off projects, but these were kind of like more like carbon offset credits. So there was no recurring revenue on these. So not quite as attractive as hopefully it could be. Today, they got about 140,000 acres of pore space that's currently under lease with an option to grow that if their partner decides that they want to. So Occidental has a DAC, direct air capture facility on NRP land. It's projected to finish sometime next year and capture up to 500,000 tons of carbon dioxide annually. So we'll see how that works out. It feels like this is kind of their test project, and we'll see how it works out. So in terms of figuring out what kind of free cash flows NRP can actually make from this, it's really hard to say. So NRP makes about 5% on their coal royalties. So you could say that's the number. But also when you look, like I looked at Occidental's, I think on their slide deck, it might be a slightly older one, but they have one that kind of breaks down the pricing for capturing CO2. And I think right now it's somewhere around like $300 to $400 per ton. And they're hoping as time goes on and as technology improves, they can get that down to about $100 to $200 per ton. So, using that number, you can kind of come to some sort of figure. But, it's so hard to say how much of their land will actually be used. I don't really know how this is going to work out, or if it even will work out. But if it does, it definitely will add to NRP's free cash flow. So now I just want to go a little bit over thermal coal and met coal just to kind of describe a little bit about where it's headed and things like that. So thermal coal is used mainly for the production of electricity. It's definitely a declining commodity. The supply of it continues going down and the demand continues going down, especially driven by the US, as we just have other sources that are reasonably well priced as well. So it's kind of replacing the need for thermal coal. So I think that thermal coal definitely isn't a zero yet, but it will be at some point in the future. There's no doubt about that. And it's not going to be next year. And sometimes when you talk to people about some of these types of businesses, that's kind of what scares them off, is that they will go away, but you have to remember these things take quite a bit of time. So NRP admits that it's going to continue going down. If you read their 10K, they fully admit it, and they're hoping that the carbon neutral initiatives will replace it. But again, hard to say. Thermal coal is a commodity, so volumes mined and prices of it fluctuate a lot. So that's why if you look at NRP's free cash flow, it goes up and down quite significantly, and you kind of have to be willing to live with that. But the positive thing about that is that because of NRP's business model, they're always free cash flow positive, which is something that you don't really see in this industry. So in the latest quarter, thermal coal made up about 25% of the royalty, which comes out to about 14 million in free cash flow. So now let's go into met coal. So met coal is used in blast furnaces in the steel forging process. It gets a lot more complicated than that, and I'm still learning the little intricacies of it. There's also basic oxygen furnaces, I think, that met coals are used in. And this is the primary driver of long-term cash flow for the business. It is a finite and declining resource. So depending on who you talk to, the fact that it is declining isn't necessarily a bad thing, because it means that it might continue going up in price. You have to kind of figure that out for yourself. There's a lot of dissenting opinions on that end. NRP, though, they've kind of signaled, I think, what they believe in, and they think that met coal is going to continue producing free cash flow here for multiple decades. So, while I think they'd probably admit that it's something that is declining in interest and demand, it still should be around here for a long time. So just the reasoning that met coal, obviously everywhere needs steel, and the reason that it's declining is that there's just been new technology out. So in a lot of Western world, more and more countries now rely on electric arc furnaces. And so the way these basically work is they just get scrap steel, and you can use them to essentially recycle and make steel. So there's certain arguments that this can fully take over from blast furnaces in the steelmaking process. But right now, the technology doesn't seem like it's quite where it needs to be to make every single type of steel. So one of the big kind of bastions, I guess, of the need for blast furnaces is in steel that's graded specifically for like the manufacturing of cars. But I've spoken to some people that say that electric arc furnaces will get to that point. I'm not sure when. So, in the developed world, met coal is not nearly as important. That kind of where a lot of it is being derived from is in China and India. So, China and India are newer kind of entrants. They're not as well developed, say, as North America, especially India. So they don't have as much scrap steel to continue recycling to make recycled steel. So for that reason, they have to rely on blast furnaces, which utilize met coal in order to continue making steel. But, both China and India, they both have electric arc furnaces. China's made it a goal to increase the amount of steel made by electric arc furnaces. So, even those two countries, which drive a large portion of the need for met coal, they're still starting to go away from it. But interestingly, if you just, Google search India blast furnace, they just built the largest blast furnace in all of India. I think this year it was completed. So clearly they're still planning on using met coal here, probably for quite a long time into the future. So now I want to get into the management portion of NRP. So current management, I think, is one of the biggest strengths of the business. So if you went back and looked at NRP, their business model has changed a lot. They ran up a lot of debt, I think about 1.5 billion. And part of the reason was that they were trying to make acquisitions. And I probably haven't spent a lot of time looking back then, but I know they spent a lot of money on acquisitions and they didn't end up adding a whole lot of value. But new management was what is, I think, exceptional. I mean, they've done a really good job adding value while also like drastically decreasing debt. So the current president who's, he's not their CEO, but he is essentially the head of the business, is Craig Nunes. He was the CFO for a few years before he took this position. So he took over back in 2017, and his primary goal there, and it still honestly is, because they still have debt, but it's down quite a bit. So you can see here, just some of the interesting things he's done. I like looking at the past of what management has done to really give you an idea of their skill level. And he's decreased their gearing ratio. You can see that long-term debt has been cut significantly. Warrants are all gone now. Preferred shares are almost all gone. He's done a really good job. And he basically, as soon as he took over, his predecessor had actually talked about this as being their goal. And Craig just kind of adopted it as his own when he took over. And he's done an incredible job here. If you go through their conference calls, it's just like, it's almost like a linear line of the business just getting more and more deleveraged and managing capital as best as he can, which basically means not investing it back to the business, but actually taking care of debt. And, he'll even do things. The fact that he's the CFO is good, because he'll look at, what are the interest rates on the debt that they have left over, and then he'll address whichever one makes the most amount of sense via, whatever has the highest interest rates. Let's get rid of that first. So I think he's very, very logical, and he's just done a really, really good job. And so we'll go over a little bit more about what their financing looks like in a little more detail later. But I'm thinking here in the next probably 2 years, they should hopefully be debt-free, meaning that they'll be able to return a lot of capital to shareholder. And then just to show you some about the insiders own about 29% of shares. So really, really good insider ownership. And then also, since he's been around, they survived COVID. Even during COVID, when a lot of their mines shut down, they were still cash flow positive. They've gone through a couple mine bankruptcies, which they've managed to survive. And they have this cash flow cushion that they like to have at all times, because they do have to end up paying some money out as dividends to both their unit holders and their preferred shares. So in case something were to happen, they want to make sure, obviously, that they can cover that off. I haven't really gone into the fact that the business has this limited partnership structure. I'm in Canada, so I can't comment too much on how it works in the US, but needless to say, they want to pay a dividend to their unit holders in order to offset that tax payment. Now I want to get into capital allocation. So you can make the argument that this doesn't really matter for a business like this because they don't reinvest. I can see that. But needless to say, if you do look at their capital allocation, it's very impressive. So I have them as return on invested capital of 39%. Again, they definitely cannot just take their cash flow and put it into their business and earn these types of returns. Like that actually to me would be a giant red flag. I actually don't want them to spend any money, because if we go back in time, like I just kind of mentioned, they were doing some M&A work and it didn't work out at all. So that's definitely not their wheelhouse. But, it's still nice to see that a business can kind of juice and milk its assets here for increasing amounts of profits. And I think that this number will raise as they decrease their equity base via share repurchases. So Buffett's rule 1, I talk about this a lot. A dollar of retained earnings should basically equal greater or equal to $1 of market cap value. And since Craig Nunes was in charge, they've created $464 of value for each dollar retained. Again, this probably isn't as useful, just because they basically haven't retained any money. It's all gone to paying down debt and paying shareholders. But it's still interesting, and it's good to know that they're not doing bad things with the money. So yeah, I already went over capital efficiency. I think will continue going up because they're going to reduce their share count, and they'll continue paying this dividend to offset the tax. So KPIs, I just kind of brain dumped a bunch of KPIs that I think are relevant to the business here, because if you're going to follow along, I think it's interesting to know which KPIs. So, I don't really have too much to add on these individual numbers. Some of the most important ones are going to be, of course, free cash flow. I definitely pay very close attention to debt. Definitely want to continue seeing that continue going down. Carbon neutral initiatives, it would be wonderful to see that start increasing. we'll see how that plays out here in the future. It's kind of hard to tell. You definitely have to pay attention to met and thermal coal pricing. And then the volumes, NRP, I think, used to show some of the volumes, but it gets kind of confusing because they have multiple partners and they don't consolidate it all anymore. They basically just rely on their partners to hopefully show truthful numbers. So you could say that's a risk, but I know they send out people to verify their numbers. And from what I've seen, they haven't had problems with people being dishonest on that end. So yeah, those are just some of the KPIs that I think are important. Now I want to talk about the route to creating shareholder value. So there's a couple different ways. Dividends have been paid in the past to offset tax liabilities, and they're definitely going to continue to be used in the future just because I don't think they're going to change this partnership structure up. It's interesting because I personally prefer the buyback route as on top of what they're already doing with the dividends, but I'll go into an interesting point of view that I talked to someone else where they disagreed with me on that. So I personally think share repurchase is going to be a very big creator of shareholder value just because the business is always cheap. So buying back your own shares seems like an intelligent thing to do. I think that, even in the bear case I have where, thermal goes to zero pretty quickly, they get nothing from their carbon neutral initiatives and met just kind of sticks to where it is. I still think they can retire a pretty significant amount of shares in the next decade here. So I was speaking to someone who made a really interesting case where they actually said if NRP were to start doing a meaningful buyback program, that would actually be a red flag. And I was very interested in understanding why they thought that way. And he made a pretty good point, which was that NRP, if you were to look 10 years in advance, its free cash flow for the entire business is likely, on average to actually go down because thermal coal is likely to go away. So that's going to obviously drop their revenues from that segment down. Met coal theoretically might go down. And if you don't think that met coal pricing is going to change much, then that means that whole segment, which makes up, 80% of their royalty revenue now is going to go down. So that kind of leaves the met coal revenue as well as the soda ash. And then, so in that sense, if you think that the business is going to get worse, then maybe it doesn't actually make sense to buy back shares. And maybe it makes more sense just to continue paying everything back as a dividend. So, it's an interesting thing to look at. And, if they were to plow back all their free cash flow as a dividend, the dividend yield would be insanely high. So, either way, you'd probably be pretty happy. I was thinking about it. I'm like, okay, well, in my head, if they were to pay all free cash flow as a dividend, would I then want to exit the business? Because I don't think the returns would be good enough. And I said, no, I would probably still stick around because it would be an insanely high dividend yield. It would probably be so high that the price of the stock actually would probably go up because it just wouldn't make very much sense. So let's look at the financing. So right now, their remaining financial obligations are around $240 million. You break it down, it's got about $211 million in debt. And then they got $32 million in preferred units, which still are earning dividends. Warrants just came off the books this year. So no warrant overhang. Coal pricing is definitely, I guess I wrote in here that it's a weakness. It's more of just the volatility of it can tell you things that maybe aren't true. So if you're going to use 2023 free cash flow as your numbers going forward, you're going to be very, very disappointed because that might not ever happen again, ever. I have decent confidence in saying that. And that would be perfectly fine with me. So, if you expect coal, like right now, coal prices are kind of weak and their numbers haven't been anywhere near as impressive as 2023. That's why I think it might take 2 years. If you use my pro forma numbers of around $250 million per year, they could get this off in a year, but I don't think they'll hit that number this year just due to coal pricing. When I look at rates of return here, I spent quite a bit of time thinking about this. I probability weighted these. Maybe the bear case should be more heavily probability weighted. And the reason for that being that met coal, to me, I'm not sure it's going to stay static. And in pretty much all of these segments, I had met coal staying static for the next 10 years. You could make the argument that while the volumes might go down of met coal, the pricing could go up, in which case it would technically stay static to some degree. I haven't run the numbers on that, so don't quote me on that. But anyways, this is kind of what I had in the bear case. Thermal coal is a zero pretty quickly. Like I have it as a zero like next year, which I don't think is going to happen. But just to simplify these numbers, that's how I did it. Met coal stays static, soda ash stays static, and zero value added from the carbon neutral initiatives. Then my base case is that I'm just using the free cash flow from their pro forma numbers here from the last decade plus. And I'm still not adding anything from carbon neutral initiatives just because it's not very proven. And in the bull case, pretty much everything else similar to the base case stays static, only the carbon neutral initiative starts adding $20 million in annual free cash flow. Could be 20 million, could it be less, could it be more? Yeah. This was just kind of a number that kind of made sense to me and seems reasonably conservative. So when you probability weight all those, I get 20.5% returns over a decade. Very, very good. Obviously the taxes eat into that for me, but just to simplify it, I didn't put that in. But it's interesting because when you crank up the probability of the bear thesis, you're still making a pretty solid return. So that's why I like this business so much. That's why I've kind of veered off my path of compounders and I like this business because it feels like the downside is very low and the upside is quite nice. This might be the last slide here, which is on destination analysis. So, what are some of the things that the business needs to do here, or, how's the business going to look like in say, 5 to 10 years? So, I think thermal coal will be a zero at some point, and that's okay. That's, kind of embedded into the thesis. I think met coal in 10 years, the volumes of met coal will probably be lower just because demand will go down. But you could also make the argument that that just means price will go up to offset that. Soda ash, I think, kind of remains at that historical average, $30 to $40 million. Maybe it grows a little bit, but, don't have to rely on too much of that. And then, the carbon neutral initiatives, that's kind of the wild card. In 10 years time, it kind of seems improbable that it would be a zero, just given all the money that's going into these and the projects going on. I know up in Canada, there's like 18 oil companies that just signed like a multi-billion-dollar deal to basically pipe their physical CO2 emissions into a reservoir somewhere. So this just seems like it's going to happen, and that would be kind of a similar strategy that NRP would take. So hard to say, but I'm fine kind of just relying on it being a zero right now until they can actually show that they can make it work. So, but I hope it works. I think it'd be really good for the environment if it does work. So yeah, I think in 10 years, the company 100% should be debt free. I have very little doubt that they will be. The only thing I could see, they like I was kind of talking about, they like having this cash flow cushion, which historically has been around $100 million, which they always keep. And that's just to make sure that if something were to happen, if they don't get their royalty payments on time, or, maybe one of their partners can't make a payment for, solvency reasons, they have the money around. So I'm not entirely sure if they're just going to rely on cheap debt in the future to keep that cash flow cushion. My intuition says they'll just keep paying off all of their debt and then just hold some cash on their balance sheets in case of things happening. So I lean towards them being debt free. And then, yeah, just some other interesting tailwinds for the business is that funding is really hard to come by in the coal industry if you want to build a new mine, especially in the US. So for that reason, the coal mines that are already up are kind of that much more valuable, because the replacement cost is kind of hard to quantify now. If you want to get funding, if you can fund it on your own, which no one really seems to do, sure, I guess you can make it, but you need a lot of money to make these mines. So for that fact alone, I think it's very good for NRP's partners that they already have these mines in place. And then, yeah, I think it's a pretty decent inflation hedge if you think that inflation is going to continue to stick around, as I think probably most of us probably do. Then that just means that pricing of coal will probably continue going up. And that just means that NRP makes larger royalty from their partners. So yeah, sorry, this is the last one, which is my kill criteria and risks. So some of the major risks are going to be government regulations. Obviously coal is not really a nice thing to be associated with in most people's eyes. It definitely wasn't in my eyes. And, I still don't think it's great for the environment, but when you really start digging into what it does for us and the fact that it's still just the cheapest way for electricity in certain countries, likely, like where I am, we don't use coal in Vancouver. But, theoretically speaking, if the US or the world were to just wanting to shut down coal, government could theoretically make it prohibitive to make it. But I think, in the US at least, I don't think it's likely because a lot of the coal is being shipped outside of the US. So it's not actually being consumed here. Some of it is, but not all of it. Another issue would be poor capital allocation. Again, I think this is very unlikely, but you never know. I mean, if they start buying things, I would assume they're going to be increasing their debt loads. And that seems to be like exactly against what the business is doing, but they've done it in the past. So, it could possibly happen. And then, like this is probably the biggest risk, is just a prolonged decrease in coal volumes and pricing. As I've said a lot this episode, I think that volumes will continue going down. And then, based on your own opinion of supply and demand, you can determine if you think pricing will go up to offset the decrease in volumes. Knowing these kinds of things, how would I kind of put this into my kill criteria? And my kill criteria need to kind of have a solid state. So, you can't just say government regulations come in and ruin the company. It's like, okay, well, what does that actually mean? So I tried to do this to the best of my ability, and it might not be perfect, but this is kind of what I had. So the government regulation part's kind of hard to quantify as a kill criteria. I don't think I can, but the other ones I can. So if I were to look at poor capital allocation, I think you would see that the business would start actually having positive retained earnings. Right now, they're negative. So if you started seeing that number go positive, it would mean that they are reinvesting into the business. And, with every other business I have, I'm perfectly fine with that happening. But with NRP, I'd prefer that they didn't. And this would actually be a pretty big red flag. I'd probably sell immediately if I saw them rising. Met coal volumes, obviously, I can accept that met coal volumes are going to go down, but I don't think that they should go down very fast. So, I have here, if they decrease at a 5% CAGR over a 3-year period from the historical averages, that might be a time to sell, because it maybe means that the met coal volumes are going down a little too fast for me. I probably should have put a section in here about met coal prices, because if volume's going down like this, but the price of met coal is going up, I'd probably be okay with holding on to it. But if met coal prices are staying static, then this would be probably a decent kill criteria for me. And then the last one here is just reduction in dividends. I think this would be another issue with them going out and making acquisitions that are not so great. So if I saw that dividend continue to decrease for 4 consecutive quarters without buybacks, if for some reason they did buybacks instead, it wouldn't be as egregious. It still wouldn't be great, but I think that would be a good signal that they're probably increasing their need to service debt. That's all I have for my NRP presentation today. I hope that that was helpful. So love to open it up for, if anyone has questions, feel free to, or thoughts, concerns, feel free to raise your hand, and I'll take those. Go ahead.
So why does this opportunity exist? Why do you think?
Yeah, I think it's interesting, because if you look at some of the other businesses in the met coal area, they're all cheap as well. And when it comes down to it, it's in mining, and mining is not traditionally the most high quality business, because you have a mine. If the price of the commodity goes down, no one wants to make it, because then it just doesn't make sense to actually mine any of it. So you kind of have to have a somewhat stable floor on the pricing. And if you don't have that floor, then it's not a good business. And that's why I think a lot of these met coal producers have these low PEs. I mean, usually it's in the mid single digits, right? So I think with NRP, it was interesting because a lot of the members, really intelligent members in this community who own other met coal businesses, are like, why not just go with the actual met coal mine? And I have to admit that I think the met coal mines definitely have a lot more upside potential, because, they are actually mining it. So if the price goes up, they could just mine more, which is great for them. But the reason that I like NRP so much is just that it's capital light. I mean, they don't own like pretty much any of the mines here that they partner with. So all the CapEx goes to the miner themselves, and they just basically manage their property. They have, 55 employees. they don't need to add more employees. So they don't have a lot of costs. That's why they have these insanely high free cash flow margins. So I think the opportunity exists just because no one wants to be associated with coal. I think a lot of these funds have investors who might be like, give me my money back if they found out that they were investing in coal. So I think that kind of keeps the price of these kinds of business suppressed. And I think that a lot of these businesses are just, the quality is not super high, so they stay cheap. And I think that, is that a weakness in terms of the share price going up over time? Yeah, probably. But it also seems like they've started to understand that share repurchases are actually a really smart idea to utilize your capital rather than just going out and building new mines that increase supply, and eventually just, if supply goes up and demand's going down, well, then that mine you just invested $1 billion in is next to useless. So the share repurchases do make a lot of sense. So yeah, I hope that's my speculation. I have no idea if that's true or not, but that's what I would say. How about you? What do you think?
Buy low, sell high. It's easy to say, hard to do. For example, high interest rates are crushing the real estate market right now. Demand is dropping and prices are falling for many of the best assets. It's no wonder the Fundrise flagship fund plans to go on a buying spree, expanding its billion-dollar real estate portfolio over the next few months. You can add the Fundrise flagship fund to your portfolio in just minutes with as little as $10 by visiting fundrise.com/WSB. That's fundrise.com/WSB. Carefully consider the investment objectives, risks, charges, and expenses of the Fundrise flagship fund before investing. This and other information can be found in the fund's prospectus at fundrise.com/flagship. This is a paid advertisement.
Yeah, I mean, that was my biggest question, because even the mining companies that trade cheaply, but for them, they have much more downside risk, right? If you have the price, generally the way commodities work is if you have a price that dips below the cost that it is to produce it, the price will end up kind of jumping back up, because then too many people are disincentivized and then they'll stop producing and then the price goes back up. So that's great when you're zoomed out, a million feet. But when you're looking at one specific company, one specific mine, maybe their cost of production is the one that's too high and they're the ones that go out of business. So you actually have a lot of downside risk and a lot of volatility in what the company is actually making based on the commodity price, as opposed to NRP, which they really have a lot of downside protection there because of the way they structure their royalties and their minimum kind of amount that they take. So even if coal prices went way too low and a lot of their customers were suffering, they would still be cash flow positive. And they don't have one customer, they have, 50, 60, and all different types of coal and all different types of cost structure. So you really have to have an anomaly in the sense that coal actually goes away, not just the volatility of pricing. So I think it's, risk-wise, I moved a lot of my coal into NRP just because I see, maybe you don't get so much of the upside swing, but I'd much rather the downside protection. I think one piece that you didn't mention, which is the MLP and the tax stuff. I guess that I love it when you're on the opposite side of a trade, when you think that the other person is making an investment decision for a non-investment reason. So you have a lot of institutions and a lot of funds that won't be in coal, and that's great. That gives you an opportunity. You also have a lot of institutions that won't invest in things that are, $1 billion. But, again, that in itself wouldn't explain the inefficient market. But then you have a third thing, which you have a lot of institutions that won't invest in something that's an MLP because of the tax structure. I hope that we're not missing anything and that altogether that's what's going on over here. And the retail investor like us actually found an amazing business with an amazing valuation. But, famous last words.
Yeah, I like your last point there too, because it was funny. I was actually just talking to a fund today in Canada that specializes in some smaller businesses, and they mentioned that they'd heard of NRP, but essentially as soon as they found out that NRP had the MLP structure, they're just like, yeah, no, I'm not interested. So yeah, like factually, that's correct. I think that it definitely does turn a lot of people away.
Yeah, I got to a point with this business where it's like, you can't help but going back to the Warren Buffett of, buy a business as a piece of a business. I mean, if you gave me $1.2 billion or whatever, call it 1.4, which is their enterprise value, I mean, with this management team in place, I would buy this whole business and probably still sleep well at night. Even in your bear case of things going away, they don't really have, 7 billion people in the world, like India and China and Southeast Asia and other places need a lot more steel. They don't really have other ways of making steel. Everyone's been talking about different things, but at the end of the day, you still need a blast furnace and met coal, and most of NRP is met coal. And even thermal coal, especially with AI and data centers, nuclear is going to take a while to come back, but just our base load, I think in the US, it's about 30 or 35% coal, and we're thirsting for energy. So I just don't see coal going anywhere that quickly. So I would be fine with buybacks because I think that the runway is a lot longer than people think. But that's, that's more me, but that's where I got to with this business. And I sized it up because I really don't see so much downside. And, even if my upside is not the same as maybe something like AMR, which I was invested in, I'd much rather kind of be protected that way.
Yeah, I completely agree with you on all those points. Please go ahead.
Yeah, I've got 4 thoughts I'll share with the community. Regarding thermal coal, I agree that it's going to have a longer downslope than some people may think. In Europe, it'll have the sharpest downslope. Thermal coal will go to zero in Europe in, 3, 4, 5 years. In the US, thermal coal will have a little bit longer slope, but it will likely also go to zero because in the US, we are blessed with huge amounts of cheap natural gas. And that cheap natural gas is actually a better choice for power generation than coal. It can literally be cheaper, and it's certainly cleaner to burn. So US thermal coal probably going to zero in 5 to 10 years. It'd be my guesstimate. However, that does not mean that all the US thermal coal mines shut down. The US exports a very large amount of thermal coal. And as our domestic thermal coal use drops, our exports have actually been going up. And there's many places around the world that have zero natural gas. And for them, coal will still be a leading choice for electricity generation because they just don't have any other economic choices. Thermal coal will likely still be the cheapest place to keep the lights on, cheapest way to keep the lights on in many cities around the world for like 20 years to come. So this is a question and a comment regarding NRP, because I don't recall if some of their miners for thermal coal can export their thermal coal or not. I forget. Maybe I didn't actually research that, or maybe I'm forgetting. So that's something we can all look into is, do some of their miners actually export? Are they able to export some of their thermal coal? Because if they can, then there could be a 20-year lifespan on that thermal coal mining. Whether or not they can export depends on their geography. In Appalachia, there's a lot of U.S. thermal coal mines that will continue to export for decades because they have a not so long train distance to a port that can handle coal exports. So Appalachia coal mines are well positioned, but by contrast, there's thermal coal in Wyoming that could go to zero in 2 to 3 years. It's landlocked, they can't export it. There's no way to get it out of there economically, and that could just go to zero as U.S. demand drops. So that's something we can look into regarding thermal coal. It's just an open question that should be pretty easy to answer is, do some of their miners that operate on NRP's property do they have the ability to export or not? Regarding met coal, I'm personally quite bullish. I think we're going to have met coal around for decades to come because I've looked at the steelmaking industry, and I just don't see any compelling alternatives that will seriously eat into met coal demand over the next 20 or 30 years. At the margin, we may have some, but I don't think it's going to be serious. That's just my own conclusion based on my research. I could be wrong. I think you did a good job, Carl, highlighting the carbon capture. When I put an evaluation on NRP, personally, I put carbon capture at zero. Not that it won't happen, but it's not a natural business. Carbon capture only works if there's government mandates, right? So it's not a natural business that you could just say, hey, I'm going to go be an entrepreneur and start a business because there's a market for it. There is no market for it. There's only a market if government mandates it, which could happen. So I wouldn't say that it is zero. I'm just saying it's optionality, and it's pretty hard to handicap that. So being conservative, personally, I just put a zero on that, but then I'm happy that there's some positive optionality. My last comment is about land value. You mentioned in a few years they're going to be debt-free. When they're debt-free, they're going to own 13 million acres of land in the United States. Even if all the coal went away, that 13 million acres of land has a value. And if you think about decades of inflation hedging, the value of that land, even if there's no coal mining, will probably slowly go up. So there's kind of this land bank aspect of the company that will actually increase in value over time. Some of that land in the future will get sold for suburban house developments or Walmart stores or towns that are expanding, right? At much higher prices per acre than may be on the books right now. So that's an element that I like about the company long term, but it's hard to put a number on that. That's it.
Thank you. Really appreciate the great insights. So I really like your point there, especially about the thermal coal and the landlocked, because if you have a coal mine in the middle of the United States, the coal either goes to the U.S. or it doesn't go anywhere. So and from my memory, so don't quote me on this because I'm not looking right now, but I'm pretty sure they do have some met coal mines in Appalachia, meaning that they are external and they are able to export. But I also know I think the majority of the thermal coal is in Illinois. So I'm not entirely sure of the cost curve of shipping it from Illinois, whether that is viable to go overseas or not.
Illinois is not. I know Wyoming is not. Appalachia is. And I just honestly can't remember where they're located and if there's that thermal coal export. But that should be easy to look into and figure out.
Absolutely. Please go ahead.
Yeah. Thanks, Kyle, and really appreciate you putting this together. Just want to share like a couple of comments. So I was listening to William Green's podcast with Brian Lawrence from Oak Cliff Capital. I think in his recent 13F, he has disclosed a position in NRP as well. The last 30-40 minutes of the podcast are related to the energy transition, and it's a very interesting podcast. And especially in that last 30 minutes, he has mentioned a book called as How the World Really Works. And I read through that book. So it's like, once you read that book, you understand like the basic pillars of civilization and how difficult it is to transition. They've already also mentioned in the book that this is the first time that humanity has taken up the challenge when it comes to energy transition with the sole goal of reducing the emissions. For the last hundreds of years, it was mainly for cost and efficiency. So it's one of the biggest challenges that we have right now. So maybe we shouldn't underestimate the transition time that it might take. Like 2050 goals may be a bit aggressive, and or the international energy agency estimates that they have been providing could be a bit aggressive. I think one of the other good points was also that I was going through one of the books regarding the oil. I don't know if you guys read it. It's called The Price from Daniel Yergin. And I think he has also mentioned a really good thing is that in 1840 or 1850, when we transitioned from whale oil to kerosene, that was regarded as one of the fastest energy transition. And it still took like 60 years to fully transition to it. And considering the capacity and the need for coal in this day and age, I would expect that especially with these two examples, I would be more comfortable to hold NRP. I know like the numbers will vary based on different regions, as you mentioned, but I think as a whole, if we are considering like exporting coal throughout the world in other regions, I think it will still be there, in my opinion, at least for the next 50 years. So just wanted to share that.
Thank you. That was great. Yeah. I think someone asked what the name of the that book. What were the names of the books that you mentioned?
Yeah. So one is How the World Really Works, written by Vaclav Smil, and the other one is the Price by Daniel Yergin. I can just write it in the chat.
Perfect. Thank you. Go ahead.
The point that you made about the land is a really good point too, because I mean, go try to buy land for $110 an acre anywhere in the U.S., even if it doesn't do anything. And I think you're very hard pressed to do that. So 13 million acres at a $1.4 billion valuation is basically $105, $110 an acre. So you really have a lot of downside protection there, even if coal goes away. But, you know, I'm not saying I would buy this company for that, but there's a lot of downside. There was something in the chat about, you know, converting. Someone said that there were talks about converting. I did a little research on kind of what would happen if you convert. And there's significant tax consequences to the owner that owns a lot, because you basically have to. I think there's different ways to structure, but basically every unit is depreciated, and then you would have to pay tax because MLP to a C corp is considered a sale. So I'm not sure if someone who owns a really big piece of an MLP really wants to convert. Maybe it's good for everyone else and good for long term, but I wonder if that would actually happen.
Yeah, that's a good point. Through my research, I haven't heard of anything about them wanting to stop. Kind of what you said, it sounds like I haven't broken it down like you have, but it sounds like it would be quite a bit of a pain to do that. Have you heard anything about that at all?
No, I haven't looked into the conversion thing. I heard some rumors about like 9 months ago or a year ago, but they were just random rumors. And I didn't dig into it at all. And I don't think management has said a word about conversion, as far as I know. So basically, I wouldn't assume any changes there. I don't see any reason to assume any changes.
Yeah, go ahead.
Thank you for your presentation and all the comments. I just want to understand that 10 years ago, the same company was trading at $400 and it dropped to $10. Trying to understand what happened in the history, how is the management transitioned, if you have any idea.
Yeah, I think I've looked at that, but I to be honest, I haven't spent much time. My guess would be that they spent about $1.5 billion in acquisitions. So I'm not entirely sure how that ended up playing out in terms of the valuation of the business. Have you looked into it back then as to understand why it was valued that amount?
I haven't looked into that history.
Yeah, I did research. I mean, part of the reason I got really excited is because they made mistakes. They had too much money and then they loaded up on more debt and they started buying stuff and there was bad acquisitions. And that's when they kind of made this plan. It was way back and they said, you know what, we're just going to divest or non-core and become what we really are, which is a royalty kind of capital light model. And we're just going to pay down debt. And what I love is that, when do you see a management team that does what they say they're going to do for 9 years in a row and it's good capital allocation? It's like really rare. So, they decided at 2015 that this is what they were going to do and they pay down all the debt. Now you're at a point where you're almost done with paying down the debt. I can't imagine that they're going to go screw up the capital allocation now and do something that doesn't make sense. They've been on this good corporate decision. They create shareholder value for the last 7 years. So
Thanks. I have second
Go ahead. Yeah.
quick question. I see insiders own 10%. Is there anybody from management coming there and the insider ownership?
From my research, it was 29%. And I think it has to do it's definitely kind of a complicated business model where there's different businesses that are owning different things. Like for instance, so NRP doesn't actually even have any. So I said 55 employees, but they actually don't have any employees. They actually essentially outsource them from two of these other corporations that are, I think it's Pocahontas and the other one escapes me. But essentially there's different parties that own different amounts. And so the CEO, Corbin McDonald, I believe is his name, he owns another corporation that I think owns a large chunk of NRP. And he's the chairman of the board and he's deeply involved in the business. So I think that's where the insider ownership goes quite a bit higher than that 10% number that you have. But I'm very happy with the insider ownership. They have their boards all, guys who are in mining and coal and seem to have a very, very good understanding of it. They have very, very good partnerships with other businesses, know the insides of the industry very, very well. So I think it's a pretty good alignment between the two.
Thank you. That's all.
Yeah. Oh, and then they do have, I've looked at their incentive program and their incentive program's essentially based on free cash flow. So that's what they're incentivized to do, is to maximize free cash flow. And then to the point about them kind of figuring out this kind of reversing the M&A thing that they were trying to do. If you're trying to maximize free cash flow, you're probably not actually trying to spend money inside of the business needlessly. So I think they did a pretty good job on that incentive structure. Yeah.
Yeah. And at least if I follow their presentation, they're clearly saying that even the carbon neutral initiatives, they are not going to run any operations. They will be purely
a land leasing company. At least they clearly articulated that they're not into getting into any operations, which is good. Yeah.
Yeah. So they're the project the direct air capture, which is done by Oxy. I think they partnered with Blackstone. So like some really, people with deep pockets are kind of getting into the industry. So, we'll see if it catches momentum, but there's some very interesting tailwinds behind it.
Thank you.
No problem. Anyone else have any additional thoughts, concerns, questions they want to share?
One more, Kyle, what's your plan? How much of a portfolio stake, and do you want it to increase? What are you looking for in the future?
Even though this isn't a compounder, I want it to be basically a full position. So I'm looking for 8 to 10% of my portfolio. Right now, it's only around 1%. Part of the reason being, like everything else I bought this year, once I buy it, it goes up in price. But even at current numbers, I think the numbers that I had run here were based off of pretty much the numbers that it's at right now. Part of the other reason it's been taking me a little bit longer is that I just really, really wanted to understand a lot more about the business before I started adding more to my position, but I'm definitely a lot more comfortable here. So the plan is to get it to a full 8 to 10% and hopefully in the next year or so.
Yeah, cool. Nice.
Thank you for tuning in to today's video on Natural Resource Partners. If you're interested in tuning into more videos similar to this one, or simply networking with our vetted community members and TIP hosts, you can learn more about joining our TIP Mastermind community at theinvestorspodcast.com/mastermind. That's theinvestorspodcast.com/mastermind. Some of the other calls we have scheduled with the community include a Q&A with Daniel Zhang from Technion, which is a popular stock amongst community members, a social hour discussing what we've learned from Charlie Munger, a stock presentation by a community member on Brookfield, and a member spotlight with one of our most passionate members. We're also gearing up for our in-person events in Omaha in May of 2025, where we'll be hosting 2 dinners and 2 social hours during the weekend. And we are also planning a bus tour to allow members to get the full Omaha experience and have a chance to meet the TIP hosts in person. And if you're in the New York City area, you'd also love our in-person events there as well, which we'll be hosting in the fall of 2025. Don't wait, as we'll be capping the group at 150 members. So I look at Old Dominion, I see their return on capital increasing over time. They've continued to expand their service networks. I think their moat's getting stronger and stronger with the passage of time. And over the past 10 years, they commonly mention how much they've invested into their service network. So over the past decade, they've invested $2 billion. And they've clearly shown that they're able to achieve higher returns than their competitors